If you watch the tape during the final 48 hours of a major trading month or quarter, you will often see a sudden, violent flush. Price drops aggressively. The tape runs red. For the average retail trader, this triggers immediate panic. They look at the cascading red candles and assume the macro bull market is collapsing. They flood social media, claiming the trend is dead. But this specific recurring calendar phenomenon is an illusion. We call it the phantom sell-off. Even junior institutional desk operators routinely misdiagnose these pre-scheduled drops. They search the wire for breaking news or unexpected earnings reports to explain the sudden downward pressure. This split-screen flow matrix shows what is actually happening. On the left, erratic retail order flow reacts in panic. On the right, cold, uniform blocks of institutional compliance algorithms blindly execute a fixed percentage offset. This massive downward pressure is an artificial liquidity distortion. Mistaking standard corporate plumbing for a true macroeconomic crash is a structural trap. When traders react to this illusion, they simply become exit liquidity for institutional accounting departments. To understand the mechanics of this drop, we have to ignore market sentiment entirely and look at the strict legal frameworks governing the world's largest sovereign wealth and pension funds. This is a standard corporate compliance document showing the exact strict portfolio allocation mandates these megafunds most adhere to. They operate on legally enforced structural asset allocation benchmarks. The true catalyst for the market flush is purely programmatic corporate bookkeeping. These executions are ordered by corporate accounting departments to balance their ledgers, not by active traders responding to market conditions. These closing ledger actions represent billions of dollars in programmatic flow. They are scheduled well in advance and hit the market regardless of global events. Recognizing this flow as forced, pre-scheduled corporate housekeeping allows you to anticipate it. Instead of a terrifying market drop, it becomes a predictable, highly exploitable vulnerability. This ledger visualizes a portfolio mandated to maintain exactly 60% equities and 40% bonds. During a bullish quarter, the equity column balloons to 65%. This triggers a compliance violation, and the algorithm isolates that excess 5% for removal. To solve this, compliance algorithms must systematically liquidate that excess equity before the quarter's closing bell rings. These programs are price agnostic. The isolated 5% equity block shatters into thousands of uniform sell orders, violently bombarding the limit order book and chewing through resting bids simply to clear inventory. As these forced sell orders hit the tape, they completely overwhelm standard market operations, creating a massive artificial liquidity distortion. This immense downward pressure is the physical manifestation of an accounting spreadsheet rebalancing itself. It creates an artificial structural vacuum entirely divorced from the actual valuation of the underlying assets. For an operator who understands this arithmetic, the goal shifts to hunting for the exact quantitative coordinates where this artificial flush will terminate. The first rule of engagement is absolute. Never attempt to step in front of the initial wave of a billion-dollar accounting algorithm. This charting interface maps the structural support walls below current price, the DRW L1 gate, L2 extreme line, and true C fading zone. The objective is to let the algorithm exhaust retail panic sellers, driving price down into these standard deviation boundaries. In the cycle's final hours, price aggressively pierces these structural vacuums. As the descending line strikes the extreme L2 boundary, high-density volume nodes instantly illuminate on the profile, indicating massive localized absorption. While retail traders are capitulating at market value, institutions are quietly absorbing that excess supply exactly at the boundary limits. By mapping these extreme coordinates, an operator identifies the exact floor of the trap. This turns an algorithmic flush into a premium wholesale discount entry. The precise temporal trigger for the trade occurs the exact moment the calendar flips to day one of the new month or quarter. Once the ledgers are officially closed and signed off, the forced programmatic sell mandates instantly terminate. The immediate structural aftermath is severe. With the massive artificial sell pressures suddenly removed, the market is left with an immense upside liquidity void. Because price is no longer actively suppressed by the accounting algorithms, a severe rubber band effect takes hold. This chart shows exactly how that looks. A clear rejection wick prints at the lower DRW dates, followed immediately by a clean, vertical price snapback, soaring straight toward the new session center pivot. The cessation of the bookkeeping event creates a temporary vacuum. It offers a clean slate and a highly probable vertical launch for those who successfully held the structural floor. Exploiting this wholesale discount requires an entirely clinical, emotionless posture toward risk management. This diagram illustrates the absolute risk guardrail for this specific setup. Your risk must be locked tick perfect to the absolute bottom of the boundary layer, placing a strict invalidation line exactly 1 tick below the entry wick. The logic behind this 1 tick invalidation is purely mathematical. By mastering the underlying arithmetic of the end-of-quarter bookkeeping trap, you permanently stop acting as retail exit liquidity. Instead, you position yourself to harvest the most predictable institutional mean reversions in the entire market.